This is probably the most important section in the morning. This is a section you should write postmortem double tax prep, aka how to avoid a lawsuit from a client. How to avoid a lawsuit from a client. Just write this down. How to avoid a lawsuit from a client. Or how to avoid calling the insurer. I get one of these every year. I get a call from the accountant and the insurer and say, uh-oh, here we go again. And here we go again, this is what it is. On the last die of two spouses, there's a deemed disposition of all the assets at death. Here's a question for you. Does the Income Tax Act promote fiscal polygamy? Yes or no? Can you be a fiscal polygamist? Everyone sounds quiet. They're like, oh, what's he asking me? Okay, raise your hand. Who says yes? Raise your hand. Who says no? Who says it depends? Who's ever said yes? Why is the answer yes? How are you married? Yes?
No, the reason I said yes is because you wouldn't have brought it up unless you had a dangle.
Yeah, I wouldn't have brought it up unless I had a dangle, or I could have just tricked you.
Or an angle.
Or an angle. What's my angle? How can you be a fiscal polygamist? How can you be a fiscal polygamist? How are you married for tax purposes? Who raised your hand? Someone raised your hand here. So you can be, for tax purposes, married, and you can be what? Yeah. What's the advantage of being married when you're living? For tax purposes. And don't say sex until you do that before marriage these days. I'm not talking about that. I'm talking before. For tax purposes, what's the advantage? You can transfer property. Come on, we're a family environment here. I'm not talking about other reasons here. I'm talking, okay, you can transfer property between spouses, what? Tax-free. So I had a client, his name is Mr. Phil Lander. Phil Lander, that's his name. Mr. Phil Lander had a spouse, and he had a roving eye and a roving something else. We're not going to go there. He had an affair with B. So he was, obviously, A found out, and A said, we're getting divorced. This took a long time because they were fighting. Then he moved in common law with B. Guess what Mr. Philander did with B? He had an affair with C. B had a clause saying, if you have an affair with someone else, I get $10 million of your shares. So what do you think I did? I said, if you are married to A, and you break the marriage and you transfer $10 million of shares to A, what happens to you? You get taxed or not? You get a lot of tax. If you're not common law with B, and what's the definition of common law? Living together in a self-contained domestic establishment in a conjugal relationship without a breakup of 90 days, right? What's the definition of conjugal? Let's not go there. Okay? So I said to also Mr. B, if you are not common law with B and you have to give her $10 million worth of shares with no cost base, what happens to you? There's a tax. So now Mr. Philander doesn't like to pay tax. So he goes, I'll do anything you say. I don't want to pay tax on $20 million of accrued gains on shares, $5 million. So what do you think I told him to do? Stay married to A, be common law with B, and do whatever you want with C. Until we transfer the shares. And he did it. Don't ask me how. He must be tired, but he did it. Okay? So this is the advantage. What we're saying is that when you have spouses, it's on the last to die of the spouse you have a death tax. Now, this is presumed on the fact that in the first to die's will, what does it say? All the assets go to the spouse. You must have a will. Some people say, oh, what happens if I don't have a will? Then you die intestate. What does intestacy say? Well, a percentage goes to the spouse, a percentage goes to your son, da-da-da-da. So what you end up doing is anything that's not gifted to the spouse, you end up with a death tax. So you need to have a will. Capital gains tax is paid on the terminal return of the deceased. Dr. X, since it's now old MPC, since he doesn't practice anymore, has a fair market value of $1 million. Assume there's cash of $1 million. Okay? There's no liabilities. Death tax equals approximately $247,700. We agree. The Tier 1 terminal return has to pay that. Johnny comes running to me. Uh-oh, Mr. Accountant, I have to pay the tax. Where am I going to pay the tax? Where do I get the tax? Accountant says, oh, that's simple. Take the money out of the estate. Take the money out of the company. You have $1 million there. Just take it out. Pay the tax. Right? He pays the entire dividend of cash. Personal tax to the estate is $401,300. $401,300. Add the two up. Death tax on death on the T1 is $247,700. Personal tax to the estate on the first terminal year T3 is $401,300. Combined personal tax is $649,000, 64.9%. What was the highest rate? 49.3. We have taxed him an extra 15%. 150 grand. Frankly speaking, forget about the accountant. The client may have done this without telling the accountant. That's what probably happens, right? The client just does it. Then they come to me. I had one client who said to me, you know, Manu, I did this. What can I do? I said, you can't do anything. You have to pay the tax. The client says, can we do a do-over? I go, what do you mean a do-over? Can we just reverse the transaction? I go, did you issue a dividend resolution? Yes. Did you T5 the thing? Yes. Did you file the terminal trust return? Yes. You paid the tax. What are you going to do? Dear CRA, we want a do-over. Please help me. Or better yet, my dog made me do it. My accountant screwed up. CRA won't buy this. So again, it is so easy to do this. I get, for the last 6 years, one of these calls every year. So I get them. So I mean, if I'm getting calls like this, it means that people are doing it, and they don't understand this. And what this leads me to believe, and I get all the calls, frankly, from Ontario. Okay? What it leads me to believe is that as accountants, we must understand this concept. You pay tax once on the outside, on the shares. You must be careful how you extract the assets out to avoid double tax. If you remember this, forget about all the other techniques, and then you call for help, call a guy like me, call a guy like someone else, you've done your job. Do not let but the moral of the story of this is, do not, ever, you must put this in writing to the client. On your death, here's my plan. Do not pay the tax from the company. Please contact me first. Do not pay the dividend from the company, liquidating the company. Call me first. You've done your job. Put it in writing. Clients tend to forget. Now, who do clients always blame besides their spouses? They blame us. I get blamed for marital problems. I get blamed for financial problems. I get blamed that the sky is gray today because I'm an accountant. So be careful. We are in a sensitive position, in all seriousness. So this is your double tax trap.